Welcome again to the Rick Helps Real Estate Show. With the number of expired listings and canceled listings that we have in this market and actually across the country, it's creating a new term in the real estate market, and that new term now is called accidental landlords. This article in Adam is talking about accidental landlords surge in markets where institutional investors are most exposed. And we're going to come back to this article in a moment, but I'm going to show you what's going on here. And here it is. This is our expired listings. Notice how they've just gone parabolic, 4,333 versus last year at 3,045. And cancels have climbed as well. The combination of those two are simply people that said, well, I tried to sell my home. There was a certain price I wanted. I didn't get it. Well, guess what some of them are doing? I guess I'll just rent it. And I saw reference to that this morning in the Cromford market report as well, saying, we do have a lot of people out there that are choosing to rent. Well, what's interesting, this article digs a little bit deeper into what's going on and said that institutional investors are highly concentrated. Large institutional investors, which means people that have portfolios of 1,000 plus single family homes, hold over 1/3, 36.8% of their assets in just 6 U.S. housing markets: Atlanta, Phoenix, Dallas, Houston, Tampa, and Charlotte. But they're facing weakening fundamentals. In other words, surging inventory and declining buyer activity has intensified buyer demand imbalances. Worsening for sale supply-demand conditions are creating new institutional competitors, accidental landlords. In other words, we're getting more competition. What it goes on to say is institutions are responding by reducing exposure and capitalizing on home appreciation gains. What that means in real terms, they're saying, well, we bought these homes a while back. Why don't we sell these? Let's take the profits, let's hold them, and let's jump in and buy some of these other homes where the prices are coming down, where the sellers that didn't get their prices decided to rent, they're probably going to want to sell down the road. Let's load our gun and be ready to pull the trigger when that happens. Now, they're floating it out as a possibility. And it says here that investors' concentration creates vulnerability. Institutional investors holding portfolios, 1,000 or more homes, have concentrated their holdings in 6 U.S. housing markets. Together, these 6 markets account for 36.8% of institutional holdings nationwide. The concentration strategy now faces mounting headwinds. So it makes you wonder, are they going to just move to other markets, or are they going to continue to concentrate on these markets? Here's where the change of supply has happened in April 2025, year-over-year change of supply. This is the percentage. Phoenix, I think, is about up 27%. And it says here that rising inventory only tells half the story. Demand sales have also declined. So this chart shows you, here's the demand in sales, and here's the supply inventory. The supply has gone down. The supply has gone up, which is the green one, and the supply has gone down. I think their chart's kind of backwards, to be honest with you. So the accidental landlord phenomenon continues. Now, what I don't like about some of these articles is they just keep talking about our increase in supply as a really bad thing, that it's spiked, that it's gone nuts, and we're less than 25,000 today. Now, most of that's because of the holiday and because we had a big reset of 1,000 expired listings at the beginning of the month. Those are now rolling off. The inventory is going to start climbing. I have it here on my 7-day moving average just to illustrate it for you. You can see that it just fell off the face of the earth. Now both numbers are going back up. We'll see what happens as we move on a couple of weeks. But remember that historical average for listings in the Phoenix market is 27,000 homes. So to jump up to 25,000, I'm sorry, it doesn't make my hair hurt, even though I have less of it. But here's this. Look at our institutional purchases right now. They're roughly 12.3% investor purchases. It's lower than where it has been. We hit a peak of 21% back in 2022. Second home markets, that surprisingly has not dipped. You hear articles that the second home market, it's tough, it's rough out there. Doesn't look like it. 10% of the sales are still second homes. 76% of sales are owner-occupied. Look how owner-occupied homes were getting beat up 2021 and 22, they were down to 63%, 61%. So there's a lot more owner-occupied homes going on. This is our active listings. Kind of drew a couple lines there. I'll show you again. I expected us to come down this line at 25,000 just based on the last chart I showed you. These will climb up here again next week. Probably be back up to where we were, and then it's going to just, I think, kind of hang in there. Months of supply are climbing. That's to be expected. That happens in the summertime, especially with volume being as low as it is. And here's our interest rates at 6.81. Are you expecting interest rates to come down this summer? I am not. I'm not expecting central bank to lower rates. Even if they did, it's the bond market that influences mortgage rates more than the central bank. And right now the bond market is sending strong signals saying, don't see it. We're open to thinking that we'll see rates come down in September, and maybe we'll react at that point. But between now and September, if you're expecting rate cuts to give us a punch and an upswing in sales in the summer, there's nothing in the tea leaves. I don't see it. Now, luxury is doing really well, and the majority of that is cash. It's doing really well. North Scottsdale, Paradise Valley. Paradise Valley volume is low. Fountain Hill's doing well, but their volume is low. But when houses are listed, they do sell. So if you've got a home, I'm going to say above $1.5 million, that market is not soft. But again, it depends on the neighborhood and the area. Some people are trying to ask like $1.2 million for homes, and they've reduced them down to $950 and ended up pulling them off the market. So it's so fragmented. It's just a strange market. But people they're waiting. They're waiting still. Now, they're not waiting on the big, beautiful bill. They know what that is now. They've seen that, so we've got it over that hurdle. Everybody's still waiting on tariffs, including the central bank. For a while, their tariffs looked like it was all leveled out, and then all of a sudden yesterday, I'm going to hit Japan with 25%. So that's probably going to slap us upside the head for most of the summer, and we'll see what's going to happen after that. Got a little tiny itch right there. So there's not a lot of hope for me as far as interest rates come down, but I don't see any desperation by sellers. And I'm seeing some buyers out there that are being tenacious, that are hanging in there and waiting for the right home, that are getting some bargains. But you got to be a scrapper. You got to be prepared to keep searching, writing the offers on the price that you want, analyzing the price on where it's listed, and then shooting your offer and staying in there for the long run. And some people are getting some surprises, getting some real good discounts and good terms. And other people are just getting, no, flat out no, rejected. Don't send me another offer. I'm done. That's to be expected. That's what happens in this cycle in our market. It'll start to balance out more as we get towards the end of the summer. Sellers that don't want to budge will not budge. They will let their listings expire because they're holding on to the hope of getting what equity that they perceive they have. And it may spring back in the fall. It may spring back next year, and they might be having the right strategy going forward. It's hard to tell. But either way, they're either going to sell by accepting a lower offer or they're going to bail. So for buyers right now, it's not a bad time to be out doing some scratching and sniffing. I know in some of the national numbers, we're seeing that mortgage applications are up. We're not seeing them up here. They're also seeing a lot of searches. Traffic is up. I think a lot of that's seasonal, and our traffic is not up here. So I think a lot of those national numbers are driven by the Midwest. I mean, why not? It quit snowing. Let's go see if we can find a home. So if you want to know what's going on in your zip code, take advantage of the link I have in the description down below, and I can send you a very detailed market analysis for what's going on in your zip code. Not your community, but your zip code, which is the same as community. But, if I send you Chandler, there's about 8 to 10 different zip codes in Chandler. You want to know what's going on in your zip code. People have been sending a request. I think I've filled out about 30 of them so far, and they're pretty happy with the results. So give it a try. If you have any questions, shoot me an email at rick@rickhelps.com. Take care.